Welcome back, focused learners, to another explainer. Today, we're diving into something truly fascinating, the massive, constantly fluctuating foreign exchange market. I mean, it's literally an ocean of capital shifting globally every single second of the day. To the untrained eye, it looks like pure, unadulterated chaos. But what if there's an underlying structure to it all? Today, we're analyzing Robert Balan's highly regarded manual on the Elliott Wave principle to see exactly how analysts attempt to find actual order within this Forex chaos.
Think about this for a second. The foreign exchange market operates on a totally fluid 24-hour cycle. It opens Monday morning in Wellington, New Zealand, and doesn't close until Friday evening in New York. The stakes of daily trading are incredibly high, and the sheer volume of variables is, well, it's daunting. Yet some traders claim they can anticipate these market turns with mind-boggling accuracy. How is that even possible?
Okay, let's dive right into this masterclass agenda. We'll start with finding order in market chaos, and then we'll break down the core 5-3 rhythm. From there, we'll establish the 3 unbreakable rules, followed closely by impulse waves and anomalies. Next, we're going to tackle the rather dangerous complexity of corrections. And finally, we'll uncover the secret Fibonacci math that ties this whole shebang together.
So, starting things off with Section 1, finding order in market chaos, and how we actually navigate the massive foreign exchange market.
To navigate a market of this size, traders rely heavily on a technical analysis discipline known as chartism. Now, chartism isn't about fundamental economic guessing. It's about providing a rapid visual analysis of price action to find support and resistance. Balan's manual uses this really fantastic analogy to describe it. It notes, learning to ride the Forex waves can be likened to a Hawaiian surfer, and that perfectly captures the reality of trading. Just like a surfer, a trader is absolutely going to face occasional wipeouts. Water dunks are just the price you pay to master the sport. But learning to objectively read the characteristics of those incoming waves, that is the absolute key to survival.
The manual points out that the Forex market offers enormous profit potential, but the real secret to unlocking it lies in 2 specific things: short-term timing and compounding. By establishing vital support and resistance levels from reading those price charts, you can make highly accurate shortened trades. And doing this frequently allows the immense power of compound interest to take effect. With disciplined timing, turning a really small initial capital base into massive growth is mathematically possible, simply because you're trading the frequent waves rather than waiting around for long-term fundamental shifts.
Moving right along to Section 2, the core 5-3 rhythm. These are the building blocks of the market.
Now, what's really interesting here is how the Elliott Wave principle attempts to take those short-term, highly destructive market movements and place them into an organized, readable structure. It takes all the chaotic psychology of buyers and sellers and literally gives it a predictable rhythm. The foundational principle states that a major market movement unfolds in a visual pattern of exactly 5 waves, numbered 1 through 5, moving right in the direction of the main trend. That sequence is then corrected by a pattern of 3 waves going in the opposite direction. So it's always 5 waves with the trend, corrected by 3 waves against it.
Let's make sure we clearly define these terms so you can mentally anchor the terminology for the rest of this explainer. The numbered waves, 1 through 5, are what we call impulse waves. They generate that forward momentum, pushing with the major trend. The lettered waves, ABC, are your corrective waves. They actively push back against that trend. Literally every movement on the chart is built upon this fundamental dance between impulse and correction.
Okay, on to Section 3, the 3 unbreakable rules, which are the strict laws governing the wave counts.
We're shifting gears a bit here, from general concepts to the very strict framework required to accurately map the market. The manual makes it exceptionally clear. Sloppy thinking is swiftly penalized in Forex. There is no room for it. Let's walk through the 3 absolute laws you must rigorously observe. Rule 1, Wave 2 cannot retrace past the starting point of Wave 1. Rule 2, Wave 3 cannot be the shortest of the impulse waves. Now, it doesn't have to be the longest, but it can never be the shortest. And Rule 3, in an upward sequence, Wave 4 cannot overlap the peak of Wave 1. Listen, if any single one of these rules is broken, your analysis is entirely invalid, period.
And this brilliantly illustrates exactly what we just talked about. Look at how these disallowed wave counts completely break those core rules. In one instance, Wave 2 drops completely below the start of Wave 1, so that's invalid. In another, Wave 3 is clearly the shortest wave of the sequence, again, invalid. And finally, when the bottom of Wave 4 crosses down into the territory of Wave 1, totally invalid. These are classic disallowed wave counts.
Next up is Section 4, Impulse Waves and Anomalies. What exactly happens when the standard waves deviate?
So, while those 3 rules we just covered are strictly unbreakable, the market is definitely going to throw you some curveballs that still technically fit within those rules. Not every 5-wave sequence looks picture perfect. Contrasting 2 accepted anomalies here, we have an extended wave. This is a really exaggerated, elongated movement that usually happens in the 3rd wave, making it massive compared to waves 1 and 5. On the flip side, we have a failure. This happens when the 5th wave weakly fails to exceed the top of the 3rd wave. It's a major sign of a reversal, and it often creates what classical chartists call a double top.
Let's quickly compare extended waves with another key anomaly you'll see: diagonal triangles. While extended waves are simply elongated impulses, diagonal triangles are these wedge-like patterns formed by converging lines. They usually show up right at the very end of a movement, specifically in the 5th wave position. The fascinating difference here is that the subwaves inside a diagonal triangle actually subdivide into 3s rather than the standard 5s. It's a really unique quirk in the structure.
Moving into Section 5, the complexity of corrections and the highly unpredictable nature of market consolidations. We've talked a lot about forward momentum, right? Well, now we have to discuss what happens when the market consolidates. And here is a crucial warning. Identifying corrective patterns in advance is notoriously difficult. Unlike those impulse waves, corrections are incredibly tricky, and honestly, they often only become truly clear in retrospect, once they're already completed. Corrective waves can increase or decrease in complexity without any warning whatsoever. This makes their depth and duration highly unpredictable. And this, right here, is exactly where inexperienced traders often lose their money, because the market consolidates in ways that stray significantly from simple, easy-to-read logic.
Let's see how this builds in practice. On one hand, we have your basic corrective forms, the simple zigzags and flats. They follow a relatively straightforward, predictable rhythm. But then, contrast that with the complex corrective forms, known as double threes. In these situations, the market literally combines basic patterns together, separated by an X wave. It creates this chaotic, sideways chop that requires immense analytical patience to trade effectively. Finally, we reach Section 6, the secret Fibonacci math. This is the mathematical code underlying all of the waves.
Because get this, the visual patterns we've been looking at are not just random geometric shapes drawn by traders. No way. They are deeply governed by a universal mathematical code, 1.618. You probably know this as the golden ratio. It is derived directly from the famous Fibonacci sequence, the series of numbers, where each number is the sum of the 2 preceding ones, 1, 1, 2, 3, 5, 8, 13, and so on. This single number is literally the mathematical heartbeat underlying the entire Elliott Wave principle.
The core ratios used to measure market waves are perfectly derived from that Fibonacci sequence. If you take a Fibonacci number and divide it by its immediate successor, like 34 divided by 55, you get 0.618. Divide by its immediate predecessor, you get 1.618. Divide by the second successor, you get 0.382. These are not just random decimals we're pulling out of thin air, they are intrinsic mathematical properties of natural growth and form.
But how does a wave analyst actually use this math in the real world? Well, these ratios serve as highly practical tools. Analysts use them to forecast the exact extent of market price movements and to measure relationships between alternate waves, like the relationship between wave 3 and wave 1. They use them to establish concrete levels of support and resistance, and powerfully, they even provide specific time windows for when a market move is actually likely to terminate.
So the crucial point here is just how striking the mathematical precision is. For example, in a zigzag or a flat correction, wave C frequently ends at exactly 0.618 or 1.618 times the length of wave A. These ratios aren't just abstract theory, they give traders concrete, objective price targets to execute actual trades right within those complex patterns we discussed earlier.
Which brings us to our final thought for this explainer. Is the massive financial market truly a chaotic ocean, driven solely by random news and unpredictable panic? Or is it just a massive mathematical pattern, a series of Fibonacci-driven waves waiting for you to learn how to read them? The Elliott Wave principle offers a highly structured lens to see the order within the chaos. Thank you so much for joining me to explore this fascinating source material. Keep your focus sharp, and I'll see you in the next explainer.